Hi, I'm Max Keiser. Welcome back to the Keiser Report. Time now to go to Rob Kirby of Kirby Analytics. Rob Kirby has been way out ahead of everybody looking at the price dislocation, the rigging of markets, the failure of price signals, and looking at the failure of price signals to understand that there's institutionalized fraud going on all over the world. Rob Kirby, welcome to the Keiser Report.
Nice to be with you, Max.
All right, Rob Kirby, your latest post on your newsletter is called LIBOR Rigging, the Tip of the Iceberg. Tell us about the LIBOR crime. How did it happen? And what's underneath the tip of the iceberg?
Well, bit of a mouthful, Max, but what's underneath the LIBOR scandal? Let's start with the Exchange Stabilization Fund. Lawrence Summers, Robert Rubin, Hank Paulson, crude oil, Ben Bernanke, Timothy Geithner, the price of gold, the price of silver, Goldman Sachs, and Alan Greenspan.
Okay, so Barclays. Is Barclays really the tip of the spear, or is it, talk about that a little bit?
Well, no. Actually, Barclays, being a London-based bank, and U.S. dollar LIBOR being it's an American-centric rate, a reference rate. It is officially posted or set in London, but U.S. dollar LIBOR is an American-centric, and when I say American-centric, I'm talking about the U.S. Treasury, I'm talking about the U.S. Federal Reserve, and specifically, I'm talking about J.P. Morgan. So it's American-centric. It is not Barclays-centric at all. And that's a misnomer and a fallacy to say that Barclays is at the heart of any U.S. dollar LIBOR scandal.
Right. Well, let me put this into another issue, because clearly the incentive to manipulate interest rates are a way to keep the bankers in business and their fractional reserve banking, their Ponzi schemes, their non-reserve banking. None of these banks have any collateral. JP Morgan has no collateral. Deutsche Bank has no Tier 1 collateral whatsoever. Concurrently with this massive global fraud, they have to also attack the one market that has a tendency to expose the fraud, and that, of course, is the gold market. So can we say without any doubt now that gold paper market and silver paper market, along with LIBOR, has been unabashedly manipulated?
Max, I'm going to take it a little step further. I understand LIBOR reference rates deal with the cost of money 1 year and less. You see, I've written a great deal about interest rate swaps controlling the long end of the interest rate curve. The LIBOR side of it is the control of the short end of the interest rate curve. So the two go hand in hand. LIBOR is the control mechanism for the short end. The interest rate swaps are the control mechanism for the long end. And effectively, it gives the puppet masters total control of the entire interest rate curve. So you got to break it down into its components. You got the short end, the long end, and then you've got the metals prices are the proverbial canary in the coal mine that typically, when we used to have free markets, sudden or big movements in precious metals would alert people historically to shenanigans going on in the interest rate markets, or if malfeasance was occurring in the interest rate markets. But what the derivatives complex serves as, a lot of people try to characterize it as debt. The derivatives complex is not debt. What the derivatives complex is, it's a price control mechanism. It's a price control grid. And it gives the people who regulate and the people who have purview over the derivatives complex, it gives them control of all the strategic pricing. The price of capital, the price of energy, the price or the cost of capital itself. And these are the things where you see the control is instituted and is most pronounced. All these strategic things.
Okay, so we're in this post-capitalist world where these coterie of bankers, they control the prices. It's not a price discovery mechanism anymore. There's no market functionality anymore. There's a grid, as you call it. It's a global grid. LIBOR is part of that grid. And these guys decide at what price interest rates should be or at what price gold should be to satisfy an objective. Now, concurrently, there's massive unemployment, social unrest, revolutions around the world, huge wealth and income gaps, and revolution in the air. So what is their end? Is their end to foster revolution? Is that what they're trying to do? Because it seems like that's what's happening.
It may sound a little bit lofty to say it, Max, maybe to some, but not to me anymore. Their goal, in my view, is one world government, one world bank, one world currency. And I really do believe that there's a coterie of clowns in the world who are that full of hubris that they actually believe they can pull this off.
If you talk about energy manipulation, gold manipulation, municipal bond manipulation, LIBOR manipulation, one bank stands tall, J.P. Morgan. Tell us about this this so-called bank.
J.P. Morgan, which I referred to as the Fed or the U.S. Treasury in drag, the size of their derivatives book, which has currently sits around 70 trillion in notional, and I mean it's been as high I think as 90 trillion a few years back, and but it's the machinations that you see, the shifting of positions, and you see J.P. Morgan enter again. It's always the strategic markets. Like we saw when J.P. Morgan entered natural gas, started trading natural gas. Within 8 months of J.P. Morgan entering the natural gas market, they were the biggest player, and Amaranth was dead. You move on to crude oil. You look at the interplay between the Strategic Petroleum Reserve and swaps that they're doing. What it is a shell game, and they move the balls around underneath the shells at will. Specifically using or utilizing or in conjunction with using, as I said, the Strategic Petroleum Reserve and good old-fashioned futures, whether it's crude oil or natural gas. And the story goes on and on and on, and it's repetitive, Max. It's not just that we see it in the energy market. We see it in the precious metals market. We see it in the interest rate market, and it's the same players every time that have the big positions and always seem to be on the right side of the trades up until very recently, when you've seen J.P. Morgan first announce a $2 billion trading loss, and now there's talk that the trading loss might be $9 billion. And I will admit it's got me a little bit perplexed just what's going on currently at J.P. Morgan regarding their loss, because I, for one, don't think J.P. Morgan is subject to accounting of any kind. I don't think they've been subject to accounting probably for the last 10 years. And my reason for making such a statement is when you've got a derivatives book of $70 trillion in notional, there's variance in terms of P&L in a position that big. So, I mean, to think that a position of 70 trillion when you induce volatility into markets couldn't have a fluctuation of, say, 1 or 2% of the outstanding notional amount in a difficult market environment, which we've had plenty of recently. But I mean, 1% of $70 trillion position or book gives you swings in P&L that are like 4 and 5 and maybe 10 times the market cap of J.P. Morgan.
So J.P. Morgan's really mark-to-market losses it's $140 billion.
They don't mark-to-market anything, Max.
Right. So they've got a book value of $140 billion, but they could at any given moment be sitting on losses between 1.4 and 3 trillion.
That would be my guess.
Right. Now, I mean, I worked on Wall Street, and I know that at the end of the quarter, of course, you keep some profits in unnumbered accounts and some losses in unnumbered accounts, and then you sell those to corporations looking for, if they need a tax loss, you sell them the loss. So I would imagine that, okay, it's a $5 billion or $9 billion loss. That's going to offset some taxes possibly. But it's complete manipulation of the balance sheet, the complete manipulation of the regulator. Meanwhile, what they don't show the regulator is this wild shadow banking snake that's whipping in the derivatives wind up and down by trillions and trillions of dollars. And meanwhile, of course, that monster gets fed ultimately in the form of austerity to the people who are starving.
There's that, but there's another angle to it, Max. I view them as a monster, and every time they need a feeding, something must die. And to a large extent, I view the Bear Stearns debacle back in 2007 the upshot of Bear Stearns dying was that J.P. Morgan more or less feasted on the carcass. And through the Lehman debacle, we also saw how there was some fast and fancy footwork being done to the tune of $138 billion, which J.P. Morgan had transferred $138 billion into Lehman's coffers so that Lehman could sell or do trades. This $138 billion that J.P. Morgan advanced to Lehman after Lehman had collapsed, in my view, there's a direct line from that to J.P. Morgan suddenly having an injection of $8 billion worth of less than 1 year swap derivatives added to their book in the first quarter of 2009. I mean, this is so blatantly obvious to me what has occurred there. I mean, J.P. Morgan wanted to be in the market. J.P. Morgan didn't want the notoriety of being in the market. So J.P. Morgan prepaid the collateral that Lehman was going to need to produce the trades that J.P. Morgan needed to do. And you know what? And I should back off a little bit, because when I'm talking about J.P. Morgan strapping on $8 trillion worth of less than 1 year swaps isn't J.P. Morgan to begin with, because the orders are coming from the U.S. Treasury, specifically the Exchange Stabilization Fund, which is a secretive arm of the U.S. Treasury, which doesn't answer to anyone, which is beyond any oversight, and these orders are being brokered through the New York Federal Reserve Trading Desk, and they're being, and basically what I'm saying, U.S. monetary policy is being conducted through the trading desk of J.P. Morgan, Goldman Sachs, Citibank, and Bank of America, and Morgan Stanley. These are the five institutions that hold 98% of $302 trillion worth of notional in derivatives that are held by all American bank holding companies.
All right, Rob Kirby, we're out of time. Thanks so much for being on the Keiser Report.
Love being with you, Max.
All right, and that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacey Herbert. I want to thank my guest, Rob Kirby of Kirby Analytics. If you want to send me an email, please do so at keiserreport@rttv.ru. Until next time, Max Keiser saying bye, y'all.